Welcome to the B.F. Anderson Technical Fundamental Report for April 27th. Gerald Loeb wrote a very good book called The Battle for Investment Survival. So note the title, Survival. He wrote the book in 1936. He was the founding partner of E.F. Hutton and was known to be a great portfolio manager and got his clients through the Great Depression. One of the things he talks a great deal about in the book is understanding mass movements. In other words, when everyone goes in one direction, which is the majority point of view, they're usually wrong. So last week, J.P. Morgan did a survey, and you know the way to measure sentiment is through surveys. There's many of them out there, but this particular survey last week said that 95% of J.P. Morgan's investors think stocks fall for the rest of the year. Another 5% think prices basically stay where they are. So here's the results of the survey. The last time we got their investors were this bearish was 2009. So if you look here at the graph, you'll see there's the low in the market. So usually you get extreme bearishness in market bottoms and you get extreme optimism in market tops. And what essentially happens, and using this as an illustration, everybody runs to one side of the boat. So the real answer here is just to be aware that sentiment is giving very definite readings right now of pessimism, which basically means the sellers are outnumbering the buyers. So we have net selling going on. Now, there's a lot of recession fears. There's fears about the banks. And we're going to talk about the banks in this particular video. Now, how bad are things? Well, you know, when you look at the fear of a recession and you see companies like American Express having a 22% jump in their revenue in the first quarter, and it was primarily due to travel, entertainment, and restaurants, which is discretionary spending. Household budgets and household balance sheets are in excellent shape. The stress index issued by the St. Louis Fed is in okay shape. It is above zero, which is not good, but look at these extreme readings of the past. And this is a reading done by the Federal Reserve, and it's basically saying that we're somewhat in a normal situation here. Now, if you look at non-farm payrolls, they're going through the roof. So if we're going to have a recession, it may be now, it may be 2 years from now, or it may not even happen. But right now, today, and that's all we can deal with is what we see today, the economy is actually doing quite well. Here's earnings are saying basically here that we've already seen back in 2022 the trough in earnings, and we may be seeing an improvement in the earnings picture. Now, we do use leading indicators, and one of our main indicators is what we call the aggression index. Now, this is a very simple ratio where we're trying to figure out what are the big institutions doing, because we know that 80 to 90% of the volume on the exchanges is funds, large institutions, pension plans, so forth. Now, these particular funds have a very difficult time going to cash. So what they basically do instead is they just start moving their portfolio into more defensive consumer staples. So you can see here back in, it really started to show trouble when it peaked in the first quarter of 2021. You know, and then we rolled over, and this would say to you, you should be very defensive here, because what was happening was the defensive stocks were outperforming the technology stocks. Now, at the end of the year last year, we did get a bounce, you know, in the first quarter, but it's now gone back on a sell signal, so we're quite concerned about it. New lows have also picked up. We're seeing, you know, way too many new lows, which tells us the sellers are basically coming back into this market. Now, one of the reasons we think this is happening, and just something we're keeping a very close eye on, is the banking system. This is the regional banks, and you can see here this week they broke to a fresh low, which is just not a positive. Now, we're just going to do a random look at some of them. Here's First Republic Bank of San Francisco, and I do think it's strange that these banks that are either failing or potentially failing are based in California, primarily in Silicon Valley, so that's just something to be aware of. But here's First Republic Bank. You can see the problem there. Here we have J.P. Morgan. Now, J.P. Morgan has been the strongest of the group, however, starting to roll over and come down again. I think the market is concerned about the banking industry. Regions Financial, just a regional bank, you can see here, broke down trying to stabilize, however, somewhat breaking down again and making fresh lows. Here we have Charles Schwab, which is where we custody funds. We're using, as a source for our cash, we're using treasury bills, 30-day treasury bills. As you can see here, the stock has somewhat rolled over, really needs to hold this level here. Now, last but not least, here's Wells Fargo, another large bank. You can see also the rollover and the breakdown. So we think that the market is concerned about the banking industry. We're concerned about it. We think that the market's going to have a tough time getting going with the banks until the banks can stabilize, and we see probably some mergers and acquisitions, and we may see some more failures. So if you have any questions, please let me know. Thank you very much.